Hey traders, in this video I'm going to walk you through a powerful trading strategy based on liquidity sweeps. This is a strategy that is designed to align your trades with the moves of the market makers. By the end of this video, you will understand the market makers' strategies and how to avoid falling into their traps. So if that sounds interesting to you, kindly hit the like button, also subscribe, and turn on the notification bell to stay updated with our latest videos. Now, let's get started. Now let's start with a scenario you've probably seen before. Imagine spotting a support level where price has tested twice. Of course, you will expect the level to still hold when price gets back to it again. And as price touches the level again, you confidently enter a buy and place your stop loss just below the support, expecting price to bounce on it and push higher. But instead, price dips below the support and hits your stop loss. When this happens, you might think that the support level has been broken and might start looking for sells. However, this is not a breakout. It is a liquidity sweep. Now, the market makers know that a lot of traders will buy at this zone, placing their stop losses below it. And that's why they manipulate this move, to trigger those stop losses and generate liquidity to fill their own orders. And when they have gathered enough liquidity, price will push up again, just as you initially predicted. But by then, you've been stopped out, watching the market move without you. Same goes to resistance. When you spot a resistance level where price has respected in the past, it seems like a golden opportunity to sell. Then, when price touches the resistance again, you confidently enter a sell position and place your stop loss just above the resistance. And suddenly, price surges past the resistance and triggers your stop loss. When this happens, you might think that is a breakout and the market is about to change trend. However, this isn't an actual breakout. It is a liquidity sweep. The move was just manipulated to trigger stop losses and generate liquidity for the market makers to fill their orders. When enough liquidity is generated, the price will push down as you initially predicted. But by then, your stop loss has been hit, and you're out of the trade. Another popular pattern that is often used to trap traders is the double top and double bottom. When you spot a double top on the chart, it appears as a good opportunity to sell. So with much confidence, you enter a short position at the second top and set your stop loss just above it. But what happens? Price suddenly spikes above that level, triggering stop losses and creating the liquidity big players need to place their orders. And when they are done gathering the liquidity, price reverses, moving in your direction. Meanwhile, you've been stopped out of the trade. The same concept applies to double bottom. When you see price forming a double bottom, you assume it's a safe place to buy. Then, you decide to enter at the second leg, setting stop loss just below the double bottom. But market makers let the price briefly dip under the level, sweep those stops, and collect liquidity. When enough liquidity is collected, price then reverses to the upside. Now, you were right about the direction but wrong about the timing. Trend lines are another popular tool used by retail traders. When price respects a trend line several times, it builds confidence. You enter as it touches the trend line again, thinking you found a reliable entry, and place your stop just beyond the line. But market makers know these patterns inside out. They push price just past the trend line to trigger stop losses. Now, most traders will see this as a trend line breakout and might start looking for buys. However, this isn't a breakout, it is a liquidity sweep. The market makers use the liquidity from those stop losses to fill their own orders. And when enough liquidity is generated, price will push downwards, just as you predicted earlier, while you have been stopped out. Retail traders and institutional players operate on two very different levels. Big players like market makers can't just throw massive orders into the market. Doing so would cause serious disruption in the market. Instead, they break their orders into smaller chunks and execute them over time. This creates areas on the chart where price tends to react repeatedly, known as supply and demand zones. These zones are key spots where large amounts of buying or selling take place. When there aren't enough traders on the other side of the market, institutions manipulate price to generate liquidity. For example, if they want to buy big, They'll build a demand zone by placing small buy orders, which causes price to move upward. But if that move doesn't bring in enough sellers, they will push price just below the zone to trigger stop losses and bait more sellers into the market. Once enough liquidity is gathered, they can complete their larger buy orders and drive the price back up. Same thing applies to when they're looking to sell. They will place small sell orders to create a supply zone, causing price to move downwards. And when they need more buyers, they'll let the price break slightly above that zone. This action traps retail traders who think a breakout has happened and triggers stop losses of early sellers. The sudden influx of buyers provides the necessary liquidity for institutions to fill their orders. And when they have generated enough liquidity, they will push price downwards in its original direction. So our strategy is built around two key elements, which is supply and demand zones and liquidity sweeps. But to trade this effectively, it's important to know whether a zone was actually created by institutions. This distinction is what separates quality setups from less reliable ones. I have developed a set of clear rules to identify areas where the market makers are operating. Let's break it down step by step. First is momentum. Observe how price moves out of the zone. Look for large, consistent candles showing strong momentum. These are the footprints of big institutions, a clear sign that the big players are active in the market. Secondly, we have zone mitigation. Only consider zones that haven't been mitigated or retested. Fresh zones are significantly more reliable, as institutions usually get their orders filled on the first retest. The third criteria is break of structure. The move from the zone should lead to the break of a significant high or low. That structural break confirms the zone's strength and signals that big players are behind the move. Lastly, we have risk to reward ratio. Make sure the setup gives you at least a 1-to-3 risk to reward ratio. That way, even a few winning trades can significantly grow your account. Now that you have understood how to spot a valid supply and demand zone, let's move on to the trade setup. Once you've confirmed a valid zone, wait for price to retest it. During the retest, keep an eye on it, because price often pushes beyond the zone to trigger stop losses of traders who entered too early, generating liquidity for the big players to fill their orders. Now, after the sweep, price often closes back inside the zone. This is the key entry signal, showing that institutions have collected enough liquidity and are ready to move the market. This is a profitable strategy that works on all time frames, but it requires proper top-down analysis. So, to increase your chances of winning, you need to align your trades with the trends of the higher time frame. For example, when you're trading on the daily time frame, use the monthly chart as your higher time frame. If you are trading on the 4-hour time frame, the weekly chart should be your higher time frame. For trades on the 1-hour time frame, use the daily chart as your higher time frame. If you're trading on the 5-minute or 15-minute time frame, then the 1-hour chart should be your higher time frame. Always make sure to check the higher time frame after spotting a potential setup. This ensures you're not trading against the broader market direction. Let's look at an example. On this chart, we spotted a well-defined supply zone. But before jumping in, we need to verify that it meets all the criteria for a quality trade setup. First thing to check is momentum. As you can see, the candles are large and consistent, indicating that institutions are behind the move. Momentum candle formation signals heavy institutional involvement. Next is zone mitigation. Notice that this particular zone hasn't been retested since it formed, meaning it's unmitigated and therefore carries a higher probability of reacting well again. Then we have break of structure. If you take a look at the market structure, you will see that the move from this supply zone clearly broke below a key previous low, which is a strong signal of institutional pressure driving the market downward. So this zone is considered valid because it meets the necessary requirements for a valid zone. Once the zone is validated, the next step is to wait for price to pull back into it. As price retraces back to the supply zone, watch closely for a sign of liquidity sweep, which is an essential trigger for this strategy. In this case, the price temporarily spikes above the zone and closed back inside. This fake-out move was manipulated by the market makers to hit stop losses of early sellers and lure buyers into thinking that a breakout is underway, generating the liquidity they need to fill their sell positions. Once the price closes back inside the zone after the sweep, it's a clear sign that the big players are ready to move the market lower. This is your green light to enter the trade. So just enter a short position from the candle that closed back inside the supply zone after the sweep. Place your stop loss just above the liquidity sweep's high to minimize risk. Then your profit target should go to the next significant low or demand zone. That's the most likely area for price to find support again. Ensure your risk to reward remains at least 1:3. And as we let the trade run, you can see how price respected the supply zone and pushed downwards, hitting our profit target smoothly. Now that you've seen how powerful this method can be, it's your time to apply it to your charts. Follow these steps, refine them with practice, and watch your trading results improve. If you found value in this video, kindly hit the like button. Also subscribe and turn on the notification bell to get updates on our latest videos.